Americans are grappling with a pervasive issue: debt. From student loans to credit card balances, the burden of debt looms large, affecting individuals and families across the nation. This financial strain not only impacts personal finances but also contributes to broader economic challenges. Understanding why Americans are drowning in debt requires delving into various factors, including cultural norms, economic pressures, and financial practices. By examining these complexities, we can gain insight into the root causes of the debt crisis and explore potential solutions to alleviate its burdens. Number 6. Accessibility of credit. The accessibility of credit in the United States has transformed the way individuals and families manage their finances, but it has also contributed significantly to the nation's debt crisis. Over the past few decades, financial institutions have made credit readily available through various means such as credit cards, personal loans, and mortgages. While this accessibility has its benefits, it has also fostered a culture of consumerism and instant gratification where individuals are encouraged to spend beyond their means. Credit cards, in particular, have become ubiquitous in American society. With enticing rewards programs and attractive introductory offers, credit card companies actively market their products to consumers of all ages. The ease of obtaining a credit card, often with minimal income verification, makes it tempting for individuals to overspend and accumulate debt without fully comprehending the long-term consequences. Additionally, the convenience of buy now, pay later options and online shopping has further fueled impulsive spending habits, leading to a cycle of debt for many Americans. Similarly, the accessibility of loans and mortgages has enabled individuals to make significant purchases, such as cars and homes, without having to save for extended periods. While these loans can provide opportunities for homeownership and economic mobility, they also carry the risk of over-leveraging and financial instability, especially if borrowers encounter unexpected hardships such as job loss or illness. Moreover, the proliferation of subprime lending practices in the early 2000s exacerbated the issue of accessibility of credit. Lax lending standards and predatory lending tactics targeted vulnerable populations, particularly low-income individuals and minorities, leading to a surge in subprime mortgages and ultimately contributing to the housing market collapse and the Great Recession of 2008. Overall, while the accessibility of credit has provided financial flexibility and opportunities for many Americans, it has also contributed to a widespread dependency on debt and financial vulnerability. Addressing this aspect of the debt crisis requires not only promoting financial literacy and responsible borrowing, but also implementing regulations to curb predatory lending practices and promote sustainable financial practices for individuals and families. Number 5. Stagnant wages and rising costs. Stagnant wages and rising costs are significant contributors to the debt burden facing many Americans today. Despite overall economic growth, real wages for the average worker have remained relatively stagnant over the past few decades, failing to keep pace with the increasing cost of living. This discrepancy between income and expenses has forced many individuals and families to rely on credit and loans to cover basic necessities, thereby exacerbating their debt levels. One of the primary factors contributing to stagnant wages is the decline in union membership and collective bargaining power, which has weakened the ability of workers to negotiate for higher pay and better working conditions. Additionally, globalization and technological advancements have led to increased competition for jobs and suppressed wage growth, particularly in industries where labor can be easily outsourced or replaced by automation. At the same time, the cost of essential goods and services such as housing, healthcare, education, and childcare has risen dramatically, outpacing inflation and further squeezing household budgets. Housing, in particular, has become increasingly unaffordable in many parts of the country, with soaring rents and home prices forcing individuals to allocate a larger portion of their income towards housing costs. Similarly, healthcare expenses, including insurance premiums, deductibles, and out-of-pocket costs, have skyrocketed, placing an additional financial burden on households, especially those without adequate insurance coverage. The rising cost of education is another significant concern, as college tuition and student loan debt have reached unprecedented levels. Many young adults are saddled with tens of thousands of dollars in student loan debt upon graduation, limiting their ability to save, invest, or purchase homes. This student loan debt crisis not only impacts individual borrowers but also has broader implications for the economy, stifling economic mobility and hindering consumer spending and investment. Furthermore, the increasing cost of childcare and elder care has become a significant financial strain for many families, particularly those with children or elderly relatives who require specialized care. The lack of affordable childcare options forces many parents, particularly mothers, to reduce their working hours or leave the workforce altogether, further exacerbating their financial insecurity. Number 4. Financial illiteracy. Financial illiteracy is a pervasive issue that significantly contributes to the debt crisis in the United States. A lack of basic financial education leaves many individuals ill-equipped to make informed decisions about borrowing, spending, saving, and investing, leading to poor financial outcomes and increased debt levels. One of the main consequences of financial illiteracy is a lack of understanding about the true cost of borrowing. Many individuals do not fully grasp concepts such as interest rates, compounding, and credit scores, which can result in them taking on high-interest loans or carrying balances on credit cards without realizing the long-term financial implications. Without a clear understanding of how interest accrues and how minimum payments are calculated, individuals may find themselves trapped in a cycle of debt, making only the minimum payments and accruing additional interest over time. Financial illiteracy also leads to poor budgeting and spending habits. Without basic knowledge of budgeting principles, such as tracking expenses, setting financial goals, and distinguishing between needs and wants, individuals may overspend and live beyond their means, resorting to borrowing to cover essential expenses. Additionally, many individuals lack knowledge about the importance of emergency savings and fail to plan for unexpected expenses, leaving them vulnerable to financial crisis and resorting to debt to cover emergencies. Furthermore, financial illiteracy contributes to a lack of awareness about financial products and services, making individuals susceptible to predatory lending practices. Without the ability to critically evaluate loan terms and compare financial products, individuals may fall victim to high-cost loans, payday lenders, or other exploitative financial services, further exacerbating their debt burden. Number 3. Societal pressures and consumerism. Social media, advertising, and cultural norms perpetuate a relentless pursuit of material wealth and status. The pressure to keep up with peers, fueled by images of seemingly affluent lifestyles, drives many to overspend in an attempt to maintain a certain standard of living. This emphasis on material possessions often comes at the expense of long-term financial stability, as individuals prioritize immediate consumption over saving and prudent financial management. Number 2. Inadequate social safety nets. Inadequate social safety nets in the United States contribute significantly to the debt crisis by leaving individuals and families vulnerable to financial hardship and unexpected expenses. Social safety nets encompass a range of programs and policies designed to provide economic support and assistance to individuals and families during times of need, such as unemployment, illness, disability, or old age. However, the existing safety net in the U.S. falls short in providing comprehensive coverage and adequate support for those facing financial challenges, thereby increasing their reliance on debt to meet basic needs. One of the most glaring gaps in the social safety net is the lack of universal healthcare coverage. While programs such as Medicaid and Medicare provide healthcare coverage to low-income individuals and the elderly, many Americans remain uninsured or underinsured, exposing them to significant financial risk in the event of illness or injury. Medical expenses are a leading cause of bankruptcy in the United States, as individuals without adequate insurance coverage may be forced to incur substantial debt to pay for necessary medical treatments and procedures. Similarly, the absence of comprehensive paid family leave and childcare support leaves many working parents struggling to balance work and caregiving responsibilities. Without access to affordable childcare options or paid time off to care for a sick child or family member, parents may be forced to take unpaid leave or leave the workforce altogether, leading to a loss of income and increased financial strain. Unemployment insurance is another critical component of the social safety net that is inadequate in many respects. While unemployment benefits provide temporary income support to individuals who have lost their jobs through no fault of their own, the duration and level of benefits vary widely from state to state, and many workers do not qualify for assistance due to eligibility requirements or limited coverage periods. As a result, unemployed individuals may struggle to make ends meet and may be forced to rely on credit cards or loans to cover basic expenses while they search for new employment. Number 1. Predatory lending practices. Predatory lenders target vulnerable populations, including low-income individuals, communities of color, and the elderly, with high-interest loans and exploitative terms. These practices exacerbate existing financial hardships, trapping borrowers in cycles of debt and making it difficult for them to escape. Addressing the multifaceted issue of debt in America requires a comprehensive approach that tackles each of these underlying factors. By promoting financial literacy, implementing regulations to curb predatory lending, advocating for policies that bolster wages and reduce income inequality, and strengthening social safety nets, it is possible to alleviate the burden of debt on millions of Americans and pave the way for a more equitable and financially secure society. Thanks for watching. Don't forget to like and subscribe to our YouTube channel.